Hey everyone, Coinbase stock price is soaring on the back of surging cryptocurrency prices. As of this recording, Bitcoin has bounced up above $60,000 again. So that raises the question, is it too late to invest in Coinbase stock? Is it a buy right now? I'll answer that question in this video looking at the company's characteristics. So let's jump right in, let's take a look at the details.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
So the first thing to consider is the company's revenue, and in the trailing 12 months, Coinbase generated 3.1 billion in revenue. You'll notice that's still less than half of the nearly 8 billion it generated in revenue in the 12 months that ended January of 2022. Remember, in 2021 was the initial surge in cryptocurrency. That's when nearly everyone and their cousin was investing in some kind of cryptocurrency, whether it was Bitcoin, Dogecoin, or whatever coin. Everyone, it seemingly looked like, was investing in cryptocurrency. Now, those investments initially, those enthusiasts, the most enthused investors have stuck around, while the general population is less interested in cryptocurrency nowadays. Even though prices for Bitcoin, as I mentioned, is above $60,000, that's on the back of a few developments, not really on the back of widespread popularity on the same level that was achieved in 2021 as a result of a number of macroeconomic factors that led to that surge. I don't think we'll ever get back to that point of popularity, but Coinbase doesn't need to get to that point of popularity in order for it to be a good investment. Right now, 3.108 billion in revenue. What really matters for Coinbase is operating the business profitably at current levels of revenue, because it doesn't look like revenue is going to get much higher in the long term. I mentioned it needs to operate profitably, and it's done a good job turning the business around. You can see as soon as that revenue started falling, its operating profitability started to collapse. In those heightened levels, its operating profit margins were approaching 50%. Those are phenomenal profitability ratios, profitability margins for any company, let alone one that only recently got going, right? So it showed its potential of what it could be at those higher levels. If it ever gets back there, then this company will be incredibly profitable. But when that revenue started to collapse, so did the operating profit margin. Went negative all the way down to negative 75%. So Coinbase did a lot of job cutting and improving its operating efficiencies, and you could see it getting better now. Negative 2.17% in the company has demonstrated what I like to call economies in scale. Economies in scale is one of the most desirable characteristics you can find in an investment. In the example I have created here, sales grow from 100 in year 1 to $115.76 in year 4, while net income more than doubles from $4.50 to $9.47 in year 4. This company demonstrates economies in scale. As its revenue grows, its profits grow by a larger magnitude. Not every company can achieve this kind of effective growth. Here's how it works. This is a typical categorization of an income statement of a publicly traded company. Cost of goods sold is what's called a variable expense. That means cost of goods sold is connected to sales. Other expenses like interest, general and admin, and depreciation are not connected to sales. You can see here depreciation stays the same at 25 whether sales increase or not. The same is true for interest expense. It stays the same whether sales grows or not. You can understand your interest payments do not increase when your sales increase. Overall, businesses typically have a mixture of fixed expenses that are unrelated to sales and variable expenses that are. When sales increase, the business leverages those fixed expenses, as we see in this example, and profits grow by a larger magnitude than the increase in sales. All right. So now that you understand why that's important, you can see Coinbase clearly demonstrating that in its business, and it demonstrated that when it was at a larger scale earlier in its history. So I mentioned already that revenue growth is not expected to be that great for Coinbase longer term. You can see 30% revenue growth expected for Coinbase in 2024. That's on the back of these rising Bitcoin prices. But then in 2025, revenue growth is expected to slow down to just 4.4%. And then in 2026, it's expected to be negative 3%. So after this year, revenue growth really non-existent for Coinbase in fiscal year 2025 and 2026. Still, these are forecasts from analysts that follow Coinbase stock. They may or may not be right. So this is a consensus estimate among the Wall Street analysts that are following Coinbase stock. Some of them might be right, some of them might be wrong. This is just their best guess for what their revenue prospects look like going forward. The next thing I wanted to look at is cash flow from operations to sales. Cash flow from operations is one of the most vital metrics I consider when making an investment decision. If any financial shenanigans are happening, looking at this metric can help uncover the fraud. Moreover, looking at profitability without considering cash flow from operations can lead to a misleading picture of a company's performance. For instance, look at the example I have created here. The company reported a net loss of $250. However, when you look at the cash flow from operations, it was a gain of $35. How can that be? Well, two expenses a company must report on the income statement are depreciation and stock-based compensation. Importantly, these are non-cash expenses. Money is not leaving the company for these expenses. In the case of depreciation, when a company buys a machine for $750, it pays all of that price up front. However, generally accepted accounting principles require that the company take the expense over a period the machine is expected to operate. So if the machine is expected to last for 10 years, the annual expense will be $75 per year for 10 years, even though the company paid the $750 cash at the time of the purchase. Also, when a company offers its employees a stock option, it's not parting with cash. However, it must record the cash value of the option as an expense on the income statement. So moving on to the working capital items, inventory management is the easiest way a company can increase cash flow. The simplest case is when a business has 100 inventory units, sells 30 units, and doesn't replace those units. The decision would reduce total inventory and increase cash flow. As you might already be thinking, this isn't sustainable. Eventually, the company will deplete all its inventory and go out of business. Accounts payable is the money that a company owes another company and has not paid yet. And accounts receivable is the opposite. A company can increase its cash flow by collecting payments faster and paying suppliers slower. If done with skill, companies at scale can take advantage of these timing differences to boost cash flow by a couple of % annually. Costco is one example that employs this strategy masterfully. Overall, if you observe cash flow increasing unsustainably, you should expect a reversal of that trend. The other big risk to consider is if you see a company reporting substantial profits but negative or weak cash flow due to rising accounts receivable. Okay, so now that you understand the importance of this, you can see 29.69% for Coinbase. It's done an excellent job from the bottom of nearly negative 100%, moving in the right direction here. Really, really good job for Coinbase on this metric. And given the cost cutting that they implemented, I suspect this to continue moving in the right direction for Coinbase, even if revenue remains relatively flat. And then finally, I wanted to look at valuation. And right now, Coinbase is trading at a price to free cash flow of 59.33. It's near the most expensive it's traded according to this metric in the little while. The valuation gets a little mixed up here. You see this blank area here because the company was negative in terms of cash flow in the recent 12-24 month period, and then it turned back around and became profitable again, as we saw in the cash flow from operations to sales metric. You can see here it turned negative and then positive again. Still, a valuation of 59.42 price to free cash flow is an expensive valuation, one that I reserve for companies that are performing phenomenally well with great prospects in terms of revenue growth, profit growth, and cash flow growth. That's something I don't see from Coinbase over the next few years, as we saw with the analyst forecast. So for those reasons, I would say Coinbase stock is more of a hold for now, and I would wait and see if the business prospects improve as Bitcoin prices continue to surge, or if we get a better valuation input, or if we get rising earnings and cash flow, then I'll certainly upgrade this stock when we get those updated numbers. Thank you for watching this video. I truly appreciate it. I know there's a lot you could be doing with your time and a lot of other videos you could be watching. So I truly appreciate that you chose to watch this one. If you want to see more videos just like this, hit the subscribe or the like button. They'll both help me make more videos just like this one. Thank you again.